doesn't explain how dozens of central banks, separated by geography and mandate, arrived at the same policy framework, the same risk models, the same threshold for action at almost exactly the same time. Central bank independence is one of the most protected ideas in modern economics. The principle is straightforward. Monetary policy must be insulated from political pressure. Elected officials set fiscal budgets. Central bankers set interest rates. The firewall between the two is treated as sacred, and in most democracies, it is written into law. But independence from government is not the same as independence from each other. And it is certainly not the same as independence from the institutions that train their economists, publish their research frameworks, and convene their governors behind closed doors 6 times a year. The Bank for International Settlements hosts those meetings in Basel. It calls them consultative gatherings. No formal resolutions are passed, no binding agreements are signed, but the governors who attend return home with a shared diagnosis, a shared set of assumptions about where inflation is heading, what systemic risks are emerging, and which policy responses are appropriate. The alignment that follows is not legislated. It doesn't need to be. When every central bank draws from the same analysis, reviewed in the same room, the policies they announce 3 weeks later will look remarkably similar. Not because they coordinated, because the framework was already shared before the decision was made. The Bank for International Settlements was not created to coordinate monetary policy.